Right guys, welcome to episode, I think it's number 12 or 13 now of the FVT Trading Bootcamp. In today's one, we're going to talk about ICT Macros. It's my core concept. It's the one you've probably been waiting for, and it may even be a longer video. See how we go. Now, just to recap today, guys, we have discussed already, we've discussed market structure, we've discussed candlesticks, we've discussed the power of three, inversion fair value gaps, order blocks, normal fair value gaps, how to use them on the smaller time frame and the higher time frame. And this concept of macros is a lower time frame concept, so you need to still understand the other stuff. And don't think that this is a holy grail, but it's going to be a way that you can approach the market on a time basis. So firstly, let's discuss, what are ICT macros? Well, if I had to define what macros are, they're windows of time. Every single hour, 10 minutes before and after every hour. So for example, first one is 6:50 p.m. to 7:10 p.m., right? And this goes all the way until 3:50 p.m. to 4:10 p.m. And that one there is obviously in the PM session. So you're going to find that these macros occur all day. And what that allows you to do alongside silver bullet, right? Silver bullet timeframes are great, but this allows you to narrow it down even further because they are 20-minute windows. Now, the next question I want to answer from the get-go is, well, what do these macros do and why these timeframes? Well, from my study and my data collection, if you don't believe me, backtest it yourself. Macros do something important most of the time. It's not 100%, but most of the time. What do I mean by something important? Well, they're going to sweep liquidity. They're going to create an inversion gap. They're going to give you some impulse. They're going to run towards liquidity. They're going to reverse and pivot. There's different things that you're going to see macros do. And those are some functions. So if you have to replay that. We're going to use it as we look at some examples now. So we know that these are what macros are. This is what they're going to do. Let's look at some examples now in the charts. And let me just illustrate this to you guys. And we're going to go back literally from today when I'm recording this video. I'm recording 2 on this day. But I want to discuss macros. And we'll go from the Asian session leading into the New York session. So we've got a macro here that exists from 7:50 to 8:10, right? If we go back here, you can see there's a macro here too from 6:50 to 7:10, right? And we're just going to go back in time. We can even have a look back here. This macro 3:50 to 4:10 and so on and so forth. So what I'm going to do here so we can save some time, I'm going to mark out these macros. I'm going to come back and then we'll discuss each macro and I'll give you my thoughts as to would I trade that macro? Do I think it's a good macro? Because not all macros are tradable. Just because it's a macro, please do not press that button. Too many people get caught up with that. And they say, well, oh, Ruben, it's a macro. Am I longing? Am I shorting? It's not about that. It's about market structure first. But let me do this first and then we'll get into some examples. Alrighty, so what I've done here, put up my personal indicator. I haven't actually released this, just a very simple indicator here to save me some time. And this is marked out all the macros, right? Now, what you guys need to do, and don't believe me, is you need to go back to all the macros and just see how many of these macros do certain things. For example, this macro spools very quickly. This macro doesn't do too much, right? So that's not really that good of a macro. This one here continues the trend. This one here just accumulates, which is fine. You can use that for other things. For example, the power of 3. This one here you can see doesn't count because that's the opening of the new day. This one here reverses, right? This one here gives you an opportunity to go long. This one here, nothing, maybe a reversal here, right? You can see, but a lot of these macros offer the tops and the bottoms and the moves. So what you can see here, even looking at New York session, this is from 9:50 to 10:10. And it's a very common macro that people like to use, but we still have to implement, here's the key, we still have to implement all the other concepts I've discussed in this bootcamp. So we've still got quite a few more episodes where I want to put more of the pieces together, but also discuss more, risk management, entering trades and things like that. Now, this is a macro, fine. That's the time window roughly when we're looking for a trade, but we still need to see things. We still need to see sweeps of liquidity. We still need to see that. If we don't have that, it's not as good. Ideally, we want to see a higher time frame fair value gap, but in this case, it's all-time high. It's a little bit different, right? But you can see all the concepts we've discussed already. We can see multiple of these concepts occurring here. So we sweep liquidity. Think back to the lecture I talked about change in the state of delivery and order blocks. We have a change in the state of delivery here. Perfect. Where's our inversion fair value gap? That occurs right there. Perfect. Where's our low resistance liquidity? We talked about this in previous lectures. There. Perfect. Where else is low resistance? Well, here. Perfect. So how do you enter a trade like this? How do how do you manage this? Well, something like this is fine, right? Like that. Take a partial, probably get stopped at break even when the price pulls back, and that's completely okay. Moving on now to maybe the lunch hour. What happens down here, right? Let's zoom out. What do? Let's put the pieces together. We sweep liquidity. Fantastic. Let's zoom out a little bit more. We sweep this liquidity. Okay, let's zoom out a little bit more, and let's go now to like a 15-minute chart, and let's have a look back here, right? So let me just start a new one. Let's go right here, and let's have a look at a 15-minute chart. Let's go there. Because again, it's about putting the pieces together. It's not about, oh, there's a macro, so I must take a trade. It's about, is there something that alludes to me that we may want to reverse from here? So we swept out this low, we sweep Asian lows. There's no 15-minute fair value gap. So sometimes, yes, I do go to a 30-minute chart when there's no 15-minute gap. We can see now, we can mark that out. Perfect. We've got a 30-minute fair value gap. We find support at this fair value gap. Perfect, right? We're trying to put the pieces together. So we've got a 30-minute fair value gap. We sweep this sell side. We find support here. Now we go back onto the 1-minute chart. This is where we look for the entry model. And the entry model is the inverse paired with this, the change in the state of delivery. We've got another sweep here, and we're waiting for an inversion gap. If and when we get that, that becomes an entry. Now you might say, well, Ruben, wait a sec. This is outside of the macro. I give it 5 minutes before and 5 minutes after. So yes, it's 10 before and 10 after. That's the macro, but I allow it a little bit of wiggle room, 5 before and 5 after, right? Just so you know, because if you're asking that question, it's a good question, but we do get it quite a bit, and that's the answer. So on this candle there, that's an entry, and you target these highs, whatever it wants to progress to, and you take partials as you go through. All right, so in this case, you can see it's printing the next macro. Takes a bit of time, but more than likely, you'd probably take a partial and then get stopped to break even, or if you're going for a one-to-one risk to reward, in this case, you put your stop below the bodies, you probably get a one-to-one there. Yeah, so you go for a one-to-one, go to break even, you probably get stopped to break even, or you trail your stop loss. We'll talk about that as we go through. So notice how these macros sometimes have good setups, but sometimes they don't. So it's not about they always have setups, but it gives you a time to look in. And what this does, a lot of people don't appreciate this. What this does, it means that you're not going to overtrade as much. Because if you're looking only in these time frames, there's way less time to trade, which means there's way less opportunity for you to risk and for you to lose money. That's the important part. And mind you guys, you're going to see this occur in all sessions, right? You're going to see this occur in all sessions. Some macros you don't need to trade, right? You might see entries like with an inverse, and a lot of people take it too extreme. For me now, I like to really see a high time frame PDRA first, then the sweep, then the inverse, then the change in the state with the macro, then the trade. Not the other way around. Like, yes, there's an inverted gap here. You can probably take a scalp, but you're better off and you're safer, in my opinion, taking trades that have a higher time frame context. If there is no higher time frame context, the chances are you're going to get wrecked in the markets. You're going to get cooked, right? So it's just a really important, I guess, concept to outline from the get-go. Not all macros are going to do something important, and not all macros do you have to trade. Does that make sense? This is a good one here from the PM session. And why is this a good macro to trade, potential to look at for tape reading purposes? We come up, we sweep this buy side. After sweeping the buy side, again, we talked about candlestick structure. Look at all these wicks, right? We have this candle here that forms an inverse, but more so when this candle closes there, right? When this one closes. Now, this one here probably would have been a break even because you enter here, your stop goes above, you probably don't get your one-to-one unless you're holding into open, which a lot of people wouldn't do, right? So in this case, you're probably getting break even, but that's a part of the process too. Keep that in mind. And what you're gonna see as times go back, let me just zoom back in price even further past where this indicator goes to. Let's just go back to a random point in price. Just a random point, right? These are obviously from some of the other videos. Let's just go somewhere here. All right, cool. Now have a look here. Now you might say this and go, well, how do you use this macro to enter? This is New York session, so 9.50 to 10.10. Yes, you can mark out inversion fair value gaps. Yes, you can do that. Yes, you can mark out sweeps, but we need to see if there's anything in the higher time frame that makes sense. And you are going to take losses. You are going to take break evens with macros. So don't think that there's a way to prevent that. It's just giving you a time frame to trade in. And what you're going to notice is that a lot of these macros offer some of the best opportunities. So if we zoom out here, look, the market's come down. let's go back onto replay mode here. And let's look at the 15-minute chart to start. Let's go there first. Is there a 15-minute fair value gap here? No. So let's go to the 30-minute chart. That's the next protocol. Is there a 30-minute? Yes, there's a 30-minute fair value gap. Perfect. So we've got the higher time frame context. We could find support there. Now we need to make sure that we've got the lower time frame context. So we've got the sweep, we've got the inversion. When's the inversion happen? Not yet. Not yet. Let's slow this down a little bit. Not yet. There we go. And that's your entry. So you enter on this candle here. Your stop can either go below these candles bodies or these candles. This one is sufficient. A lot of people go for a 1-to-1 and then they go break even. That's what I promote on this channel. And you let the price do its thing, right? So you let the price play out. Whatever it wants to do, it'll do. Let's just zoom out again. Zoom back in, sorry. And you can see here what would have happened. You would have taken a loss, right? So don't actually get to the 1-to-1. Now, a lot of people in this position, they go, well, oh no, my strategy must not work. You just have to wait until the next macro, guys. Just wait until the next time frame. So if you take a loss or you take a break even, wait until the next time frame. Here you've got 10.50, which is right here, and you've got 11.10, which is right here. And I'm focusing a bit more now on session specific. So New York session to start and then London session later. Let's play it out. Now remember, there is still a fair value gap here. Remember we discussed there's a 30-minute fair value gap. Now we sweep that out. Perfect. We're getting close to the macro. Let's see what price wants to do. So it's starting to push up. What's price do here? We pull back. We pull back into the range. There's a macro here. What's this? What's that? That's your inversion fair value gap. So notice how you can take a loss to start, but you have to have the confidence to be able to re-enter again for the next macro. Your stop can go here or here, depending how aggressive you want to be. And to make back this loss, right, you just need to take it to here. But once you build confidence, you'll take a partial here and then you'll hold a runner. A lot of the time I tell people when you're starting, you start with a 1-to-1, then you go for a 1-to-1.5 for the runner, and then you extend it as time goes on. Don't expect all the low resistance liquidity to be taken out. Sometimes it gets taken out, other times it doesn't. And the worst thing for you and for most people would be, oh, I need this to hit. I need that to hit. I need my 1-to-2, and what happens? You get break evened. So just remember that, right? Just remember that. When you look in the markets, it's not a 100% way to do things, but it's going to be a way that you can approach the markets where at some point there's going to be a framework that suits the model. And you got to stick to this. And you're going to see this specifically for London and New York session, but also Asian session too. It works. It works in all sessions and all time frames. Even here, for example, look at this, right? Mark out this macro. I'm going to mark this out manually now. So have a look at this. 650 is right here. Boom. This must be a higher time frame fair value gap. So what does price do? We tap into this higher time frame fair value gap. We sweep liquidity. What is this? This is a macro. What do? We create an inverse. We trade back into that inverse here. Now let's be hypothetical here. Let's say you entered here. Your stop loss originally, we'll talk more about this, but let's say your stop loss is maybe about here and you're riding it up here somewhere. Assume you get stopped to break even. Okay, doesn't matter. The next macro is coming up. In the next macro, what do? You wait for the inverse. You take the trade. You trade back into it. You take the trade as the price pushes, or take the trade from there, right? And then you put your stop below this candle and you ride it to where you want it to. Does that make sense? So losses are a part of the game. Break evens are a part of the game. Half trades are a part of the game. You know, even here for London session, right? We have this area where we find support, and I talked about this in a previous video. For example, we have an inversion fair value gap that's created up here, right? So you might enter something up here and you get stopped to break even. Wait to the next macro, re-enter again. And this will limit how much you trade, and it'll actually do good for your trading. Does that make sense? Now you go back in price. You can look at the Asian session, you can look at the PM session, you can look at the London session, but you're going to find there's a lot of opportunities around these time frames. Like that's 145, that's the macro, right? This one here is not a macro, but what is this up here? A macro. So you can enter a little bit higher up in the range with a tighter stop and still take it. All right, what's over here? 948, that's very close to the macro. That's good enough. Again, 5 before and 5 after that macro is completely fine. What's this? 750 to 810. What does price do there? We form this inversion fair value gap. What does that do? It allows you to have an entry. Okay, Let's keep going back in price. So you're going to see these things repeat and repeat and repeat. And sometimes it's not going to work. Sometimes it's not going to be perfect. But this is the repeatable system that you need to follow. For example, here, maybe you wanted a short, right, during this macro. So you take a short here, change in the state, sweep of liquidity, you take the price lower. Maybe you don't, right? So go back in price, and my advice here would be to mark out all these macros and identify for yourself how many times they pivot, how many times they accumulate, how many times they offer a good setup. And what you're going to find, in my opinion, is that a lot of the times these macros and around these macro timeframes will give you some of the best quality setups. And that's what I said. And that's why I started trading macros. That's why the bulk of my trades, 85% of my trades, are ICT macro based. And I'm trading based on these timeframes. So I approach a session, right? And I'm looking for these things to happen around the macro, right? This macro, 350 to 410, we pivot, right? Here, this is not necessarily a macro. That's fine. We use market structure. Here, is this a macro? Yes, that's a macro, right? What do we do there? Change in the state, sweep, inversion, we take the trade. Let's go back, right? Where's this? 1049, 1050, what's that? A macro. What does that do? It pivots. What's this? 950 to 1010, macro, we pivot back up. So longs, there's shorts, there's everything in between, but you're gonna have to mark this out for yourself so you actually trust it, right? And not every macro do you have to take a trade, but it's an opportunity for you guys. If you feel like you're over trading and maybe you trade the New York session, that's 2 times the trade and that's it. So you'll pretty much have 2 opportunities. You're not going to do more than that because it's 2 macros. London Open session, there's a few more, and same with Asian, so you've got to be a bit more restrictive. Now, before we get any further, because this might be a bit of a longer, I guess, episode here, and it's just off the top of my head, guys, this is all the important stuff. I would go and check out some other videos on macros. So pause this video, get another tab open, and I've got a playlist on macros. After this one, I would watch that one too, or all those. There's like heaps of videos, right? So with this bootcamp, what I've tried to do is I've tried to summarize the important points, the common questions that I get asked in macros. And another common question is, do they work on other pairs? Yes, they do. They work on Forex, futures, Bitcoin. It works across all timeframes and all instruments, right? So go back in price, right? And that's my advice for you. See how many times things happen around a macro time frame. Look at this. That's within that 15-minute period. And have a look, right? You're going to see these things repeat. Look at this, 350 to 410. You're going to see these things repeat. I wonder what time this is. 950 is right here. 5 minutes before is right here. That is a good long position. Using the power 3, using the inverse like we talked about. But now we're combining this with macro. So every single thing I've talked about, right, even here, right, this is a macro. Everything I've talked about, please note this. Fair value gaps, inversions, change in the state, power 3, macros. You combine them together, and that is your A+ setup. That is my model. That's how I trade. There's no secrets. It's all laid out on the table here for you guys, but you got to put in the work, right? And that's it. So if you stay this far, that is my model. That is my A+ model. That's the model I teach everywhere. And there's, I guess, nuances in price in regards to that, but that is the model. There's no secret, right? There's no secret. That's the model. And so that's what you should study. That's what you should study. It doesn't matter what session you trade. Like if you trade Asian session, I trade it too. Look at this. There's a macro. That's a good long. What else do we have here? Let's go back in price. Let's go back another day. All right, let's go back. There's a nice position here. Let's go back a bit more. Interesting. Wonder what time this is. A macro. What do? We reverse down to up. What do we do? Power 3, accumulation, manipulation, distribution. So all these things will happen in all sessions, right? For those that trade London session, which I trade personally, look at this. Macro-based trade. Right here. Bang. 1-to-1, break even. Beautiful. Okay, where's the next opportunity? Next macro, right here. Right, long position, roughly from there. Start with 1-to-1s and then aim for more as time goes on. So 1-to-1 and probably break even there too. Perfect. What about this? What if you can't trade London session? Well, look at that. It's the same concept. We come down, we create a change in the state, we create an order block, you enter a long position here, you take it higher. But Ruben, I can't trade any of those time frames. I can only trade, Asian session, well, it's fine. Asian session will also have setups, but it depends what you're looking for as well, right? So you might be looking for a certain something, like say, for example, here. You might be looking for something to happen here during this macro. There's an inversion fair value gap there. We've got price finding support at this bullish gap right here. And I know I'm doing this very loosely, but you get the point. We invert a gap here. There's a macro, there's low resistance, liquidity, and we push higher. So just know, guys, that yeah, you're going to see this in all time frames and all sessions. And I mainly trade, here's another example, 10.50 to 11.10. We go from down to up. Pretty interesting, isn't it? So you're going to see this happen all the time. What about here? The low is formed at 2.15. That's within that time frame. We pull back into the range. Swing high, swing low. Dealing range, we push. Interesting, right? Another one here, boom. Right, so you're just going to see a lot of examples. Here's another one too. Accumulate, manipulate, boom, macro, we push higher. And so I want to kind of conclude the video on that by saying if you're still here, congratulations, you've made it further than I reckon 98% of people. Macros do multiple important things like discussed. It's just another confirmation. It's just another confluence, right? So you can't just go, for example, you can't just say, oh, it's a macro, so I'm going to place a trade. You can't do that. But what you can do is you can say, okay, there's a macro. Are we inside of a fair value gap, a 15-minute gap or a 30-minute gap? Do we have low resistance to target? Is an inverse forming? Do we have a change in the state of delivery? Is there impulse? Do we have these things? If we have these things, then I'm going to take the trade. If we don't, it's probably not a good trade, or it's not an A+ setup, so it doesn't deserve as much risk. And that's where I'll leave you guys. So we're getting into the nitty gritty here, and I'm going to have some more, I guess, lessons as we progress into psychology and things like that, because I think that's important to include here. I've done one video so far on that, on setting realistic goals, but we'll do more on that in the future. So with that being said, guys, another great video. Hope you enjoy this one. Any questions or comments, leave them down below. And if you're not yet in the free Discord, join it. It's free, join the community. And I'll see you guys there. All the best. Have a great week.